Let me preface all this. So folks, what we're going to talk about here is we're going to talk about I bonds. And you may be familiar with them. I might tell you one or two things you didn't know about them. And the reason why I was talking with George about it last week is because we're coming up on a really important deadline that expires at the end of this month. And so if you want to take action on what I'm about to talk to you about here, you don't have a lot of time to do it. So basically the way that an I bond works is you buy an I bond and you have to hold the bond for a year. The Treasury won't let you sell it back to them within the first year. But when you decide to sell it back to them after that first year, the Treasury gives you all your principal back, right? So this is risk-free, just the way like a U.S. Treasury is that you hold to maturity. And then it pays you an interest rate above that. And that interest rate is calculated off of CPI, and it's actually calculated off of the increase in the CPI in the previous 6-month period. And what it does is it updates the interest rate it pays on an I bond twice a year, once in November, and that's the deadline that's coming up, and the other one that's in April. And what's good about when you buy an I bond is you are guaranteed when you buy it that the current prevailing interest rate it's paying, you're going to get for the next 6 months. So you're locking it in for the next 6 months. So right now, I bonds are paying an annualized interest for the next 6 months at a 9.62% rate.
So this is basically like buying a 1-year Treasury that pays 9%.
It is almost. So that's the first 6 months. So then you got to figure out, okay, what's the next 6 months going to be? And I'm actually going to tell you a little bit more about that in a moment. But yeah, so think about it like I'm going to compare it to owning an I bond a Treasury bill for a year in just a second. So yes, you should be thinking about it the same. So as I mentioned, the interest rates updates every 6 months. The good news is going into November now, there's a calculation. Like I said, it's based on the increase in the CPI over the past 6 months. We just got the September CPI numbers, so we now pretty much know what the interest rate is going to re-rate to starting in November. So if you buy right before November, you're going to lock in that 9.62% rate for the first 6 months of your I bond. Then we now know pretty much that the rate for November, which kicks in next, is going to be about 6.5%. I think it's 6.48%.
Okay.
So if you blend those together, so you're going to get the 9.62% for the first 6 months. Then it's going to re-rate to the prevailing interest rate at that time, which we now know is going to be 6.48. So if you blend those together, you're going to get an annualized rate of return on these I bonds of 8.05%.
Yeah.
Okay.
And when's the deadline, Adam?
The deadline is you got to buy it before November 1st. Now, when I started looking at this, I put out a couple of videos on this starting about 2 months ago or so. Back then, a 1-year T-bill was only yielding about 3%, right? So I didn't know exactly what the second 6 months were going to be, but I had an inkling, right? And so I was sort of comparing that 8% to 3%, right? So it's like all the safety of a 1-year Treasury bill, except it was yielding like 2.5% more, or 2.5 times more. Now the delta is not quite as good, but it's still pretty darn attractive. So right now, a 1-year T-bill is yielding about 4.5% right now. And then again, compared to 8.5%, you're not quite doubling, but you're getting close, right? Again, for holding pretty much for the same amount of time, and everything's risk-free. You get your principal back. The interest that you earn is free from state and local income taxes. It's a super good deal. Okay, so you're maybe wondering, well, why haven't I heard about this? The main reason why is you're limited in what you can buy. So an individual can only buy $10,000 worth of I bonds a year. So, people with a lot of capital say, oh, well, then that's not super relevant for me because I can't really park that much away. Can only do $10,000, right? So yeah, maybe I'll do it. Maybe I won't. I'm going to tell you a way to dramatically increase the amount of money that you can put into an I bond today and take advantage of this, what I consider to be probably a pretty rare window of opportunity to get this annualized 8% return. As I look at the outlook for the CPI, George, I think it's going to be coming down over next year.
Yeah.
I for one reason or another, I think the inflationary surge that we're dealing with right now is going to be, CPI is going to be probably substantially lower, than it is
Both
right
you and
now.
I are in the disinflationary
The
camp going
disinflation
into
camp,
Q1, if you want to put it in those terms.
Yeah, so I don't think the deal on I bonds is going to be nearly as good going forward as it is right now. And so let me tell you about how the mechanism for multiplying your return on I bonds, and then I've got a little George Gammon whiteboard I'm going to put up here for folks to take a look at. So first, anybody or any entity with a social security number or tax ID can buy that $10,000 worth of I bonds a year. So let's assume for a minute you're a family of 4, right? So everybody in the family can buy an I bond. So that family of 4 all of a sudden is now buying $40,000 worth of I bonds. Now let's assume
even if they're under 18.
Even if they're under 18, even if they were just born yesterday, right? As long as they have a social security number, they can buy or can be bought in their name for them up to $10,000 worth of I bonds. If you have a trust, a family trust, that can buy. Or if you have an LLC, and lots of people have multiple LLCs, each one of those can buy. So this can really begin to multiply depending upon your personal situation. Now, the other thing that you can do is you can gift people I bonds. And this is where the really interesting part of the story comes into play. So I can gift you an I bond and you can receive it. And that can be the $10,000 worth of I bonds that you use in a given year, right? I can give you a $10,000 I bonds, you take it, you're good, right? Let's say you bought I bonds already this year, right? And then I gift them to you today. Well, you can't receive them because you've already bought your maximum allocation for the year. So they go into a gift box where the Treasury is holding them for you.
Right.
But what's important about this is that those I bonds in the gift box start earning interest as of the date that they are gifted. So let's say you bought your $10,000 yesterday because you were excited to get the tasty 8.5% return. I then gift you $10,000 worth additional today. You can't take receipt of them yet. They go in the gift box, but they start earning that same tasty 8%, right?
Right. So to be clear, Adam, when can you take receipt of them?
So you can take receipt of them, and I'm going to explain all this in the whiteboard I have in a second.
Okay.
You can take receipt in them in any year where you're not putting your own money in to buy an I bond. So let's use this example I just gave. You've bought your $10,000 this year. I gift you $10,000 now. They go into the gift box. Come January 1st of next year, you can say, okay, I'm not going to buy myself. I'm just going to take the $10,000 that Adam gave me out of the gift box. And now that's my allotment for this year.
But they've been accruing interest this whole time.
But they've been accruing interest that whole time.